righty. Our next guest calls this the most complex market of his career. Julian Emanuel's been on Wall Street for more than 3 decades, so it's a long career. He's the senior managing director at Evercore ISI. Julian, good to have you with us.
Great to be here.
Why is this the most complex market of your career?
Well, you actually set the table the last few minutes, and I just want to pose this question. If a year ago you knew we were going to be at 5+% at this point on Fed funds, could you have with any confidence said the economy would be doing 3%? And even more importantly, could you have said that weekly jobless claims would be hugging 200,000 week after week after week, showing that there really is just this unbelievable resilience?
So how do you explain that? How do you explain what you just described?
So the way we explain it is to acknowledge that the kind of stimulus that we saw in 2020 and 2021, and the Fed was still buying bonds during a portion of 2022, is unlike anything that we know except for World War I and World War II. And it was so much that, in fact, all this tightening is still really only working off the residual effects of the stimulus. There's still $1 trillion worth of excess savings out there that's keeping the consumer going.
Stimulus versus the tightening that is taking place now.
And the bond market is everything. So I thought, again, maybe it's through my lens, but the move lower in yields on Friday, it seemed to me people were positioning for something over the weekend. Flight to quality in the form of bonds, selling the market off in anticipation of something. That unwound today, which says to me yields want to go higher. Yields should be higher, but they haven't impacted the broader market. What's the line of, the point of diminishing marginal returns when things start to get dicey?
So I think we've seen it to a certain extent, okay, because if you go back to the peak in July, it really got to a point where all the hype around AI, a lot of which we think is justified in the long term, but all the good news was priced in. The wall of worry was beaten. Stocks and yields were rising the same, and then that stopped. Now, with the 10-year yield sort of, trying to go to 5% and staying below there, it's okay. And in our mind, sets up the precondition for what we think is a fourth quarter rally to 44.50. But I think if you get materially over 5%, it's sort of that roundophobia, the psychology changes.
So you said that the reason we're probably at where we are in the market today is the sort of pile up of all the stimulus that was. Are we still getting stimulus in the economy today from the IRA or from monies that are being appropriated to defense to replenish Ukrainian stocks, and now maybe money that will go to into the Israel-Hamas war?
So there's certainly an argument to be made for that, and I think one of the challenges in this dysfunctional place that's known as Washington is whether all of these bills are presented, can be passed, increasing the deficit further. But by and large, you're really just at this point where the stock of the excess saving, the stock of that accumulated stimulus is still large enough so that it's only being worked off, as opposed to tightening, as opposed to more stimulus.
So, Julian, when you mentioned this, deficits, and again, so the question about further fiscal stimulus and the like here, like some of the smartest minds out there, they're really concerned about these deficits, right? That just keep expanding. Pre-pandemic, the Fed balance sheet was at, $4.5 trillion. It got up to $9 trillion. It's worked off down to $8 trillion or so. So when you think about this, okay, so fine, a consumer has excess savings of $1 trillion. It's just been shifted from one place to the other. So consumers might hold up this time around, but is there a concern about these fiscal deficits? Because I keep hearing, the big dogs here keep mentioning this. When Paul Tudor Jones, I think, was on the air the other morning, they keep mentioning this, and sooner or later, chicken's got to come home to roost.
So we, in our collective investing lifetimes, have probably been focused on this issue as a question of when, not if, for probably 20 years. And frankly, if you had shorted bonds in response to that trade, you were a consistent money loser over the. That's no longer the case. And I think when you look at the past 30 days in particular, with the gridlock and the dysfunction in Washington, that's part of the bond market saying that deficits matter now.
All right, Julian, thank you very much for your perspective. A complicated time, to be sure. Appreciate it. All right, let's trade what Julian just said. You go first. How did you take what he said and apply it in a portfolio?
Well, let's see. You've got the push-pull between stimulus, and then you've got essentially the quantitative tightening that's essentially trying to work off. And I think it's a matter of time, as I've said before. So I'd report that QT is going to flow in. I actually think bonds, at least intermittently, you can probably short those and expect to make money on the long end of the curve. I would also probably be looking at still trading the short to intermediate portion of the Treasury curve. And then I think in terms of the more economically sensitive pockets of the market where we've continued to see things hold up, we've had that consumer excess savings, I would probably expect that to roll over. And so I'd probably be at least neutral to short those areas of the market.
Julian says 44.50 on the S&P by year end. Does that sound reasonable to you?
We're right there. I mean, we're
right there. We're 70 points
away,
away.
70 points away. I mean, it could happen tomorrow, quite frankly, and we've seen that before. It's counterintuitive to everything sort of I was taught and raised on in terms of the market, but the market has a way of making, in putting on the most impact, the most pain for the most amount of people. And it feels like the upside is that, but you can't deny that everything going on in the bond market, everything going on with the credit markets, HYG now not trading particularly well, at some point has an impact on the broader market.